Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about where we can expect housing data, especially mortgage rates, to go in the next 3 months and into 2025. Logan, welcome back to the podcast.
It is wonderful to be here. And I just want to add that I know you have fans that tell you Logan must be, very difficult to work with, because there are times where you are telling me, hey, I need to talk, and I'm still talking. And the acting background in me, I'm looking straight at the camera, right? And
Right.
sometimes I'm going to miss your cues, but I'm staying focused on what I'm saying.
Yes, most of the time fans tell me how much they enjoy what you're saying. So it's just sometimes they're like, but yeah, you don't get to talk a lot. I was like, yeah, that's true. I don't. But that's because I'm the interviewer. So I appreciate that. So we have a lot to talk about today. Let's turn our eyes to 2025, and let's think about, what you see coming down, what your outlook is.
I take my forecasts really seriously. It's been the staple of my work because I always wait to the end of the year, and not only do I detest 2-year forecasts, I don't even comprehend like how people do that. Like, look out. And I know there's this old adage saying with housing, especially home prices, because inflation is always growing post World War II. We are very rare a deflation economy. Home prices tend to rise because of inflation, right? So I understand that logic. I also think it's somewhat lazy to do, because there are periods of time where home prices go faster than normal, and periods of times where you don't really have any kind of real home price growth, which is a lot of people don't even like to even discuss real home prices. But in this regard, today, we're not going to give like a full-fledged 2025 forecast, but we're going to talk about what to look for the next 3 months going out into 2025, because we actually have something different in 2024 that we did not have in 2022 and 2023. And that's that mortgage rates fell kind of in November and December the last 2 years. And that's close enough to the seasonal push in existing home purchase application data. And it gives you a kind of an idea of where things are. In both times, we had about 500,000 home sales increase in the early parts of 2023 and 2024. But after that, rates rose up. And then it comes right back down to that kind of 4 million level. So obviously, we don't crash a lot under 4 million. And obviously, unless rates stay lower for longer, we don't really grow either. So I think going out for the next 3 months, October, November, and December, what we want to see is, because there's a change in the Fed is not going to, be restrictive anymore. But, the question is, how much lower can mortgage rates go if the economy is stable? So I think that is something that we need to look at for the next 3 months, because you and I have talked about this for how long? The slow dance, right? The slow dance about the 10-year yield and 30-year mortgage. Well, that's what happened, right? We had a forecast. We talked about this 380 level. We said the labor data need to break to go underneath that. We did, but then the economic data outside of one report has firmed up a bit. So I think what we want to focus on is, what does the data look like each week going out the next 3 months? Now that rates are at the low sixes, we have not been able to hold it here, since the big rate move higher. So I think this is going to be the first time we're going to test this market out with lower rates. Obviously, the builders outperform in this environment because they can go even lower with sub 6% mortgage rates, but we're close enough towards 6% to see, is this good enough to keep sales and purchase apps growing? Then the seasonal demand curve come, which means it'll be the first time in a few years that we get somewhat of a traditional backdrop to really look at purchase apps in a normal fashion. The counter to this argument right now is that the economy booms and the 10-year yield goes up higher and the Fed starts, Mickey Mousing again. But I think this is how we should look up for the next 3 months and then going into 2025. Because if the Ford, ladies and gentlemen, boys and girls, women and children of all ages, if the forward data starts to get better again, and people choose to ignore that now for the third year, that's on them. It's no longer on anyone else, right? We create trackers and everything for people to be versed, but it's exciting for me because we're at this level and we're not near the seasonal demand curve for purchase apps.
Okay, so that's what I wanted you to clarify is when you say the forward-looking data, what specifically do you mean?
Okay, so when we think of housing data, because how we look at housing is so much ahead of everyone else. Number one, what's the 10-year yield doing? Number two, what's it doing for mortgage rates? Number three, the spreads. Okay, so now we're beneficial at that point now. Then we think about, okay, what's purchase application doing? The mistake still today, oh, I see it every single day, is that people don't think anything's happening. There is literally a material change in the data from what we were earlier in the year to now. So a very good understanding, 14 negative prints, 2 positive prints when rates were going up to 7.5%. Now rates heading towards 6%, 11 positive prints, 5 negative, positive year over year data. So that's the front line. Then we want to see our pending contracts data, where we think we're a little bit more stable than the NAR over the next 3 months. Let's see how the pending contracts do. Why? Because rates started to go lower a few months ago. Purchase application data started to act a little bit better. Purchase application looks out 30 to 90 days before sales. So we're going to have a 3-month period. As long as rates stay out here, get a good test in a non-seasonal time frame, like what's going on. And then we actually want to see, do we have another volume kick in starting in November and December? And if rates don't go up higher, I think this will be an authentic look on pending contracts and purchase apps going out. And it'll be months before it hits the sales data. And, then we could actually see, okay, can we actually grow sales and have it stick in 2025? That's why I think the next 3 months is a good test case for us. Even though it's not a seasonal period, we have been able to show to get a little bit more volume heading into the year than in previous years.
I do think, when you started the tracker and we had talked about it and then you just pulled the trigger, I think it was right around Christmas Day.
Yeah, I was
uh,
not supposed to start the tracker until January. I was like, no, I'm starting it, right? I mean, it's something I do for myself. It's something I, kind of discussed, but I think having everything in one place and having all those data lines and knowing that that data is today, people are like 2, 3 months behind us. At least we get an idea what's happening today and what could happen in the future. And this is, to me, a more prolific way of talking about it because I've already seen the same mistakes in the last 2 years. And we talk about this in videos, right? The forward-looking data is getting better and people just don't want to go with it. And you see that really in the new home sales sector, which again, today, and slightly off topic, I'm imploring everyone, if you're listening to people that say new home inventory is just like 2008, this means millions of, oh my God, oh, headache. Guys, it's 105,000 completed new homes for sale. Majority of the monthly supply are homes that are under construction and haven't even started yet. When those homes typically have a buyer in contract, when they build it and get ready, they have to do the last part of the loans and they move in. This is why the builders do not provide you millions of homes of inventory, right? Unoccupied inventory. That's not how it works. So the builders forward-looking confidence index got better 3 months ago. But now I think this is a good case of let the tracker guide you, either negative or positive. When it gets positive, working for real, you get to see the difference. And this is why I kind of liked, by the time this Monday comes out, we'll have another tracker in there, but at least it gives people a functioning, working live data line rather than waiting for the existing home sales report, which is already gonna be like 3 months old anyway.
Okay, so I have a question. I think rates can be very confusing for people, and especially, we've talked about why rates didn't fall after the rate cut by the Fed. People are watching it really closely. Matt Graham runs Mortgage News Daily, talking yesterday, today about Freddie Mac's numbers and how we're not at the lowest point yet compared to a couple weeks ago. It's just confusing. What do you think about all that?
So everyone should know Freddie Mac mortgage updates is like, y'all remember the tortoise in the Bugs Bunny, cartoons? That's what Freddie Mac is in the world, and the media picks it up like it's normal. Then there is people like Matt and myself where we're slow dance, 10-year yield, what happens daily. So if you're ever working with a weekly average, you're going to be slow, and it catches up. So what happens is, like, you only live once in this world, and you don't want to be old and slow. So, for HousingWire or Mortgage Rate Center, when people go in there, there's going to be my take initially. I wait until like the economic reports come out and where I see the 10-year yield going, and then where pricing should be. That's today, right at the second. The slow dance. These people never stop. This is like Soul Train 24/7 since 1971. No commercials. There is no stopping here. If you're looking at the Freddie Mac, it's weekly, it's old. So it's like catching up to where we were. Like, you remember 10-year yields at 360? We're like, oh God, this is really low. Oh my God, housing starts came in as a beat. The 10-year yield rose well before the Fed made their announcement, right? Because the economic data was getting better. And we were very overbought on yields. So I think that's the confusion, because if somebody's working on old weekly or weekly averages, you're going to lag on the freshest data. You know me, I believe in the freshest, livest. Sarah, do you know, like, I get up at 1 a.m. and I'll put a 10-year yield chart, overnight trading, and I'll put I'll put a moonlight, some music on and stuff like this. We don't want to be slow.
No,
we want to be up to the date. So I think that's the confusing part. Matt was trying to clarify that the current pricing is already well ahead. So on these very wild, aggressive moves on a week-to-week basis, or even a 2 to 3 week basis, you're going to be, if you're following anyone that has weekly averages, it's just going to lag. And then it's like, now people see these headlines and everybody runs with it, lower some mortgage rates, but mortgage rates are already gone up. So remember, 24/7 live Energizer Bunny here, right? We do it fresh. And if you're following like Freddie Mac or something like that, it's not going to catch the current to the day pricing.
Right. So our Mortgage Rate Center not only has you do a daily update, you do a video on there. We have the rate lock data from Poly on there. So I think that's really great because it shows not like some ideal rate, but like what actually was locked. And so I think it
really gives everybody a real-time look on the lock process of how the housing markets work, and you can trail that into the economic data. That's why I feel like Poly's information is very useful. It gives you kind of a real-time setting of what's actually happening, because everyone has to remember, when you see live pricing, unless you're already in contract, doesn't really do anybody good. It's like some people go, oh my God, somebody should lock. Have you filled out a purchase application or oh no. So you're not doing anything. You have to get into a contract day, and there's all this stuff. So the Poly data actually gives you what real-time data is actually being locked, which is useful, especially on the economic sense.
Okay, so we've talked about rates. What other things are you looking at, right? Inflation's always top of mind, even though we know that labor over inflation always. Exactly.
Labor over inflation. Today it's Friday morning, so the PCE inflation, personal consumption expenditures, that's what the Fed tracks. Their 2% target is there. The year-over-year headline is 2.2%. The month-to-month data is running at, we almost actually had a flat print this month, and that's what the Fed really wants. They want these month-to-month prints to be below 0.2 basis points. So anything close to flat, they'll be happy with. So inflation was last year's story. It's just that the labor market is the thing that mattered, right? So the 10-year yield fell just a few basis points after that, and I think it's a little bit lower right now, Friday morning. But again, labor over inflation, the growth rate of inflation fell last year. There's no reacceleration happening. There's some base effects that might fight a core, and then we might go into that again in the first few months of 2025. But the inflation data was a little bit higher this year back then. So that's kind of old story. It's labor data now. And what does that mean, Sarah? What's this week? Jobs week. So that's what we're doing right now. So this week, what are we going to think about? Job openings, headline prints, quits, percentages. Those are the things that matter. Jobless claims always, that comes out every Thursday. It was good again yesterday. The jobs number. Now here's the thing to be mindful about this week. The 3-month average is lower than probably the Fed wants to admit that they want. If I look at what I was always looking for was, when are we finally going to get 140 to 165,000? The closer we get to 159 million, we should have already been there. I was like, oh my God, did I really mess this up? Our job numbers are a little bit too big. What's occurred is, after the revisions, 12 months is a little bit higher. 6 month looks about right. 3 months is less. That 3 month is a deterioration. So we're going to see what that means now, especially now that rates have gone lower and the builders are a little bit more confident. Maybe you get a little bit more pickup on construction jobs. But that's if you get another weak print, you're going to get more people talking about 50 basis cut. And, maybe neutral isn't going to be good enough. So jobs week is more important than inflation. And we're going to have a big one this week. Jobs weeks are always more important because, again, the Fed has not gone to an accommodative stance. They're talking about, well, we're restrictive today, but we want to slowly get back down to neutral. Remember, we've had this conversation for since 2022. The Fed told us they want the 3, 6, and 12-month core PCE in a kind of an average, and that's where they want the Fed funds rate to go to. Oh my God, we have a lot more to do if that's the case today. But if the labor market starts to deteriorate even more, you might start to get from maybe neutral? No. What is accommodative, right? That's a whole different story, right? That's where mortgage rates can go even lower, right? Spreads could get even better. And if you want to talk about a sub 5% mortgage rate, that's what you kind of need out there. So that's why jobs week is a little bit more important. Inflation isn't the story anymore. And it's still crazy to think that we actually had lower mortgage rates with higher growth rate of inflation. But the market eventually figures itself out over time.
Absolutely. Okay, what else should we be looking at?
Oh, it's Labor Day. So we focus on the tracker data. We focus on jobs data. We focus on how the bond market reacts. And the bond market reaction now is more critical than any other time this year because we've already made the big move already. So we should not have anything in that regards to do we get another massive move lower? We're not going to get another massive move lower until the labor market gets much weaker. So that's where we focus on, is how does the bond market, how does the 10-year yield work off of the labor data? That's all. Remember, the whole thing about housing, it revolves around the 10-year yield. Forget about mortgage rates. The bond market, spreads, those are the things that matter. And now everyone finally gets to see it happen in a beautiful violin perfection symphony this year, that the labor market was getting weaker and the 10-year yield got ahead of it. And the Fed's like, 50, so always going to be behind. They're always going to be on. The bond market, on the other hand, no. So we'll see how the bond market reacts toward the labor data. Maybe all the labor data beats to the upside. That, in a sense, wouldn't be good for yields going lower, but it's our good first test. It's our first jobs week after the first Fed rate cut, and we'll see how it reacts to it.
Well, this week for HousingWire, we have our IMB Summit. Super excited. Wish you could be there, but you are already booked on your nerd tour, as you call it. So you are talking somewhere else. But we will be talking about a whole lot of things on Tuesday in Dallas. And then you are set up for our economic summit that we're planning for 2025. So that's just a preview, everybody.
Logan, Chart Daddy, Las Vegas. When this comes out, that's where I'm going to be. And we got a nice little wardrobe for the Las Vegas. Oh, it's going to be a show. It's going to be Ocean's 21 all over. There we go. We're going to play it,
I
baby.
did ask you, what does the shirt look like? You're so famous for your shiny shirts.
No, it's a brand new shirt, right? The question is, how am I going to do the hair? Because think about it. What other human being could go head to head with my hair? Who could it be that's very famous for Las Vegas?
Hair. Oh, okay.
Uh-huh.
Yeah. Oh.
Uh-huh. Oh, yeah. Elvis Presley versus Logan Mohtashami hair contest. That's what we're going to do, you know? So I got to get one of those fake Elvises, and we're going to have a hair off competition. And I guarantee you, I could even beat Elvis in a hair competition. Elvis got nothing on me.
I would not bet against you in a hair competition against anyone that I could think of. So you've got it locked up. Well, Logan, thanks so much for being on today. We will talk to you again soon.
Pleasure. Thank you so much.